What if I told you that while I was cruising Lake Zurich, eating world-class chocolate, and managing trades from halfway across the world, I still managed to outperform the market in my trading account by more than 50% this year? Hey, this is Isaac from Streetwise Economics. I'm officially back in Canada after 10 days in Switzerland. The views were amazing, the chocolate was so good, and yes, I was trading and also managing my investment portfolio while traveling. But today, we are talking about what's going on right now, particularly in the US stock markets, as well as the bond and currency market, because volatility is back. Bond yields are breaking records, and some big names like Google, UnitedHealth are making serious waves. However, I always like to start off by disclaimer that the video and the content that I share on this channel are meant for educational and informational purposes only. Trading and investing comes with both risks and rewards, and you should always do your own research or consult a financial advisor before making investment decisions. So, let me start off by a quick market pause. Let me give you the big picture in terms of the US stock markets, which had a sharp turn this week. I'm recording this video today is 22 February, 22 May 2025. Now, on Tuesday, the Dow Jones dropped over 800 points, nearly 90% of New York Stock Exchange stocks ended in the red, and the S&P 500 snapped a six-day win streak, and the Nasdaq saw its first loss in 3 sessions. Now, I've been investing long term for years now. I would say I started investing seriously in about 5 years ago, but I focus mostly on stocks with the strong fundamentals, not hype. And when the entire market moves like this, even the long term focused investors, they pay attention. The reason, bond yields. Now, let me go a little bit in details in terms of the bond market and give an explanation in my view of why the yields surged and why it is something that is very important. The 20-year US Treasury yield surged past 5%, and that's very, very important. And the 30-year yield is hovering around 5.1%. To put this into context, these are borrowing rates for US government. Rising yields means it's getting more and more expensive to finance everything from mortgages and corporate debt. This spike was partly triggered by last week's US credit downgrade by Moody's and a weak treasury auction, signaling investor concerns about the federal debt and fiscal policy. Today, as I'm recording, there's a lot of talk even on Bloomberg TV here that the potential impact of the bill that was the tax cuts, about $4 trillion US dollars, that's going to be in tax cuts in the US. And these policy changes, they have consequences both to the equities market, that is, you're looking at the stock market, the bonds market, you're looking at the treasuries and bonds, and also the currency market. Why? Because a lot of money is invested in those markets through various instruments. So things like that, they really call for investors or even traders to adjust their portfolios accordingly. So that's what causes volatility, and money is made or lost if you are on the right call of those moves. So the key thing is that for investors, the red flag is that when the bond yields start to be volatile, right? It might be an opportunity for fixed income and dividend paying stocks, like people who focus on those. But for me, the key thing is that I keep an eye on is When volatility returns, I pay attention to the VIX and the dollar. The VIX, which is Wall Street's fear gauge, is climbing fast, up 9% from the day before and 62% a year ago. Translation, it means that the markets expect more turbulence ahead in the cockpit. So it's not just about stocks. The US dollar has been sliding down over 7.5% this year. Weaker dollar means stronger exports, but also it makes imports and travel more expensive for Americans. I'm a Canadian and I like it that way in a way, but the thing is, if my Canadian dollar is appreciating relative to the US dollar, it means it will be easier or cheaper, I would say, for me to travel and spend money in the US because I would need less Canadian dollars than I was spending before to buy the same amount of American dollars. Now, if you are investing globally or thinking about it, these current shift matter. The effect They affect everything from ETF performance to commodity prices, like I indicated. So, what did I do this week? Now, let's bring it back to my portfolio. This week, I added more shares on Google to my long term portfolio. I'm not saying you should go out and buy it, that's not what this channel is all about. People have different risk preferences, but I'm just sharing what I'm doing and in the process what I'm learning. But here is why I have made this move. Google just wrapped up their I/O conference showing off major AI investments, including new Gemini models and Android XR smart glasses. And if I look at the top tech stocks in the US, I would say Google is the one that has been lagging behind because of quite some numbers of issues like their AI models, but also the Department of Justice issue of case that they are investing Google, and all these things they kind of like cause some investors, in my view, to kind of like play it safe. So, but for me, I like to play long term, and one way to make money in the market is, if you are right, is to buy when there is fear and uncertainty, and if that particular security is discounted. So that's why I added a few more shares on Google. And I like to do it gradually. Now, despite the recent pullback, like I said, due to the antitrust scrutiny, I think the dip on the Safari based traffic, I remember I was in Switzerland and I saw Google dropped by almost 12%. And I was kind of like, what's going on? And I did some more research. And when I looked at the distribution of the revenue on Google, the stock, and also even Alphabet, just looking at the distribution and the valuation, I was like, I still think, even if Apple says we are going to develop our own search engine and maybe the 20 billion or so that they are paying, the Google still has value because YouTube, if you think of Google search, still there are a lot of other competitors, and also with AI models, you're thinking of other advanced models that are coming out. Still, Google, I think it has a legacy in terms of the market share that it might still be a good investment in my view. Again, this is just my view, and I'm not saying that's what you should necessarily do. So I also like to maintain cash secured puts, and I'm playing lifts on my trades. Basically, I'm buying options that are longer dated, especially when the stocks that I'm particularly following they really drop, and then I get in and I get out very fast. In case I'm caught up in there, let's say the market drops quickly, I will still have some time for the trade to play out. But ideally, I like to take my cash, my profit, once I see the profit, and then I wait for another opportunity, and then I multiply my money that way. Now, the stock focus on United Health and Google has been making waves, like I said, but United Health deserves a closer look because it is, I think, the biggest health insurance provider in the US by market capitalization. But the stock has been taking a beating, down nearly 50% from April highs, and Department of Justice investigations, Medicare pressures, and management changes and sentiments are shaky because the CEO indicated that he was leaving, but also there were a lot of negative news. So, but for long-term investors, these are moments when these valuations can be attractive. So, if the fundamentals remain intact, I am looking at, right now it's trading at around 300, but it went down to um, below like 360, and I got in and I took a quick trade and I exited with a profit, and that was it. I wasn't really convinced, even though the directors from United Health, they were buying. That could be a sign that they still believe in the business, but it's a big business. Think of all the health, okay, insurance claims and all this. Is a big brand. I think it's a too big to fail a business. But the idea is you can still lose money if you buy at the top when it's overvalued. But right now, I think below 300, in my view, I think it's still a good buy. I'm not saying you should buy. I also don't have a position right now because I am preferring to deploy my money in specific sectors and specific stocks, and some of which I have shared with you guys here. So, what does this means for traders, for investors? So, for me, we are in a risk environment. So stocks are shaky, bond yields are rising, the dollar, particularly the US dollar, is under pressure, and individual names such as Google and even United Health that I shared, they are being hit hard and reacting hard to headlines. This is the time, in my view, to revisit tolerance. It's very important to ask yourself, are you overexposed in high growth names? Are you diversified across sectors and asset classes? This is very important. Do you have enough cash to take advantage of market dips? I like to always have cash that I can deploy. Like right now, I also added even Aritzia on the other portfolio for our family portfolio because it pulled back to a certain level that I was comfortable adding some shares. So that's how I deploy. If you don't have money, if the equities market it drops, then what that means is you're just going to say, the market is down. But, like what happened around 7 or 9 April when the market really dropped, I was deploying. And once you deploy capital when the market is at that level, and you know exactly good and wonderful businesses that you are buying in terms of the shares, then you are more likely to make money in the long term, all things equal. So volatility is uncomfortable, but it also creates windows of opportunity for disciplined investors. These are moments that people can build wealth over time. To wrap it up, while I was away in Switzerland, the markets didn't stop, like I said, and neither did my trading plan. I'm back in Canada now, back in the zone, and I'm focused on helping some of my clients how to navigate this roller coaster with clarity and purpose. So, if you are serious about improving as a trader or investor, especially if you are just starting, check out my one-on-one coaching over at www.streetwiseeconomics.com. Let's build a strategy that fits your goals and future lifestyle. And I always like to be transparent about this. I'm a coach. I'm not an investment advisor because a lot of people sometimes they just come and say, oh, I want you to tell me what to do, what stocks to buy. That's not what I do. I teach, I educate people to say, okay, these are the things that I'm doing, these are the things that I'm looking at, this is how I'm valuing businesses. So that's different from telling people what to do. I just always want to clarify that because sometimes people think there's just a way to cut and paste. If I had that, it would have been very easy. But The market is always changing. So sometimes you really have to be educated in terms of knowing, what to keep an eye on, and also a portfolio that fits your particular situation. Now, I always like to say, encourage you guys to say, if you're one of those people who are watching these videos and hopefully enjoying these videos, subscribe, like, share, so that this video goes viral. Share this with someone so that a lot of people will get more educational content like this. Until next time, trade and invest smart and wisely, and stay streetwise. May the markets be on your side. I will see you in the next video. Bye bye for now. Isaac signing out from Canada here. Bye bye.